What if I told you that someone legally paid zero taxes on $1 million salary, or that you could potentially deduct your entire vacation as a business expense? Today, we're diving into 10 of the most jaw-dropping tax loopholes that actually exist in our tax code, and some of these will completely change how you think about taxes forever. Before we jump in, I need to be crystal clear about something. These loopholes are real, they're legal, but they often require specific circumstances and professional guidance. Always consult with a qualified tax professional before implementing any of these strategies. Now let's uncover some secrets that the wealthy have been using for decades. Our first loophole sounds almost too good to be true. It's called the Augusta Rule, named after the famous golf tournament location. Here's how it works. You can rent out your home for up to 14 days per year and pay absolutely zero taxes on that rental income. Think about it. If you live near a major sporting event, concert venue, or popular destination, you could potentially earn thousands of dollars completely tax-free. Some homeowners near the Masters tournament in Augusta rent their homes for $20,000 per week during tournament time, and every penny is tax-free under this rule. But here's where it gets even more interesting. Some business owners have figured out how to use this rule in creative ways. They rent their own homes to their businesses for meetings, conferences, or corporate events. As long as they charge fair market rates and don't exceed 14 days, the rental income is tax-free to them personally, while their business gets to deduct the rental expense. It's a legal way to move money from your business to your personal account without paying taxes on it. The second loophole involves something called depreciation recapture avoidance through like-kind exchanges. Real estate investors have been using this strategy for generations. Normally, when you sell investment property, you have to pay taxes on both the capital gains and recapture all the depreciation you've claimed over the years. But there's a way around this using what's called a 1031 exchange. Here's the magic. If you sell your investment property and immediately reinvest the proceeds into another similar property, you can defer paying those taxes indefinitely. Some investors have built massive real estate portfolios this way, rolling their gains from property to property for decades without ever paying capital gains taxes. The key is timing and following very specific rules. But done correctly, it's like getting an interest-free loan from the government that you might never have to pay back. Our third loophole centers around something most people overlook: the home office deduction taken to its absolute legal limit. While many people know about basic home office deductions, few understand how extensive these can actually be. If you legitimately use part of your home exclusively for business, you can deduct a percentage of virtually every home expense imaginable. We're talking about mortgage interest, property taxes, utilities, insurance, repairs, maintenance, security systems, landscaping, even pest control. If your home office represents 20% of your home's square footage, you can potentially deduct 20% of all these expenses. For someone with a large home and high expenses, this could translate to tens of thousands in deductions annually. The key word here is exclusively, though. The space must be used only for business purposes to qualify. The fourth loophole involves charitable remainder trusts, and this one is particularly clever. Let's say you own stock that has appreciated significantly, and you want to sell it but don't want to pay the massive capital gains tax. Instead of selling it directly, you donate the stock to a charitable remainder trust that you set up. The trust then sells the stock and pays no capital gains tax because it's a charitable entity. Here's the brilliant part. The trust then pays you an income stream for the rest of your life, typically 5 to 7% annually of the trust value. You get an immediate tax deduction for the charitable donation, you avoid capital gains taxes entirely, you receive income for life, and whatever remains in the trust goes to charity when you pass away. It's a win-win-win scenario that allows wealthy individuals to essentially have their cake and eat it too. Our fifth loophole deals with something called income shifting through family partnerships. This strategy allows high-earning individuals to share their tax burden with family members who are in lower tax brackets. Here's how it typically works. A successful business owner creates a family-limited partnership and gives or sells partnership interests to their children or other family members. The partnership income is then distributed according to ownership percentages effectively moving income from the high-earning parents' tax bracket to the children's lower brackets. When done properly, this can save families tens of thousands in taxes annually. The children pay taxes on their share at their lower rates, while the family keeps more money overall. It requires careful structuring and ongoing compliance, but the tax savings can be substantial. The sixth loophole involves strategic timing of stock losses to offset gains, but taken to an advanced level that most people never consider. Professional investors use what's called tax loss harvesting throughout the year, not just at year-end. They'll sell losing investments to realize losses, then immediately buy similar but not identical investments to maintain their market exposure. The sophisticated part is that they'll also use these losses to offset other types of income beyond just capital gains. Up to $3,000 in capital losses can offset ordinary income each year, and any excess losses carry forward indefinitely. Some investors build up massive loss carry-forwards during market downturns, then use these to offset gains for years or even decades into the future. Our seventh loophole centers around business entertainment expenses that most people don't realize still exist. While the tax law changes in recent years eliminated many entertainment deductions, there are still several categories that remain fully deductible. Business meals are 50% deductible, but meals provided for employee convenience can be 100% deductible. Here's where it gets interesting. If you provide meals for employees working late, during meetings, or for the convenience of the business, these costs are fully deductible. Some creative business owners have structured regular lunch and learn sessions, working dinners, or on-site catering that qualifies for full deductibility while providing a valuable benefit to their team. The eighth loophole involves retirement plan maximization strategies that go far beyond basic contributions. High earners often feel limited by traditional retirement plan contribution limits, but there are ways to contribute much more than the standard limits suggest. Defined benefit plans, for instance, can allow contributions of hundreds of thousands of dollars annually for the right type of business owner. Cash balance plans are another option that can allow massive contributions, especially for older, high-earning individuals with few employees. Some professionals have legally contributed over $200,000 annually to these types of plans, getting massive tax deductions while building substantial retirement wealth. Our ninth loophole deals with conservation easements, which have become increasingly popular among wealthy landowners. This strategy involves donating development rights on your property to a qualified conservation organization. In exchange, you receive a charitable tax deduction based on the reduction in your property's value. The key is that the deduction is often much larger than you might expect. If you own property worth $1 million that could be developed, but you donate the development rights and restrict it to agricultural use, reducing its value to $300,000, you could potentially claim a $700,000 charitable deduction. This deduction can often be carried forward for several years if it exceeds your current income. Our final loophole involves something called captive insurance companies, which represents one of the most sophisticated tax strategies available. Large corporations have used this strategy for decades, but it's increasingly available to smaller businesses as well. The concept involves setting up your own insurance company to insure the risks of your operating business. Your operating business pays premiums to your captive insurance company, which are tax-deductible business expenses. The captive insurance company receives this income, but as an insurance company, it has special tax advantages and can build reserves tax-free. If claims are lower than expected, the captive insurance company keeps the profits, effectively creating a tax-advantaged profit center within your business structure. These 10 loopholes represent just the tip of the iceberg when it comes to advanced tax planning strategies. The important thing to remember is that tax law is incredibly complex, and what works for one person might not work for another. Each of these strategies requires careful planning, proper documentation, and ongoing compliance with tax regulations. The wealthy didn't get wealthy by paying more taxes than legally required, and they've been using strategies like these for generations. The key is understanding that tax planning isn't just about filing your return each April. It's about structuring your financial life throughout the year to minimize your tax burden legally and ethically. If any of these strategies caught your attention, the next step is finding qualified professionals who can help you determine which ones might apply to your situation. Remember, the goal isn't just to save money on taxes, but to build long-term wealth while staying completely within the bounds of the law. What surprised you most about these loopholes? Have you used any tax strategies that saved you significant money? Share your thoughts in the comments below, and if this video opened your eyes to new possibilities, make sure to subscribe for more insights into the financial strategies that can change your life.